Whereas if there were no regulators, then the public would be more suspicious and they would actually do better due diligence.
Yeah, and it's kind of funny in that whole world of driving pensions up the risk curve. I think the Ontario Teachers Union also invested in FTX,
yes,
and lost a bunch of money.
Yes, so now the government could be on the hook for those losses.
And I think you could almost make the argument that the rising interest rates kind of drove this blow up in FTX. And I'd like to get your thoughts on, what this new era of higher inflation really means for investors. How do they need to change their strategies in order to deal with this new era of higher inflation and higher rates?
Yeah, well, what they have to come to terms with is, to the extent that they made money in the last decade or longer, it's not because they were smart. It's just because they were lucky to have ridden the bubble. Mm-hmm. It was all a function of the cheap money and the artificially low interest rates and the fact that inflation hadn't reared its head. But now that we're in a different environment where inflation is here, it's high and it's going to get higher. Interest rates are no longer zero. They're going to get higher, even if real rates are not. Nominal rates are going to be rising. And the air is coming out of the bubble. In a high inflationary environment, distant earnings don't have nearly as much value, which means that companies that don't have earnings today or have, a low earning and trade at a high PE, that's unsustainable. When you think there's very, very little inflation and the cost of money is next to nothing, if there's a company that may have a profit in 10 or 20 or 30 years, the present value of that profit, could still have a lot of value today. But in an environment where you have higher inflation or high interest rates, the value of those future earnings is dramatically reduced when you discount it into the present, which is what a stock price does. So people are not going to be betting on the come the way they were during the bubble. So as an investor, you have to go back to basics, be a Warren Buffett kind of value guy. You have to understand the business and what am I paying for this business? And am I paying a good price? And how do you know you're paying a good price? Well, what's the dividend yield that I'm getting? How many years of earnings am I paying to buy this business? And those are the things that nobody even cared to ask when it was like, well, what's the name? What's the symbol? Is it going up? Oh, I'll buy it, right? Mm-hmm. Does it have a sexy story? We're not about the sizzle anymore. It's about the steak. A lot of these stories were all sizzled. There was no steak there when you got right down to it. And so it's, old-fashioned stock picking, value investing. Forget about the indexes. You're going to lose money in the indexes because they're dominated by these overpriced stocks. I think for most people, it's going to be international, not domestic. The U.S. is really where it was at the last decade or so. We have the biggest bubble. I think the dollar is going to fall sharply, and so that's going to undermine the real returns on U.S. stocks, which are going to be negative anyway. So I think you got to look at international markets. You got to look at emerging markets, which I think are cheap relative to developed markets. And you got to look at commodities. You got to realize that, energy, agriculture, metals, this stuff, is underpriced, going a lot higher. And that means the companies that have these resources and that are harvesting them or, extracting them or whatever they're doing, they're going to see big increases in their earnings as, they're getting higher and higher prices for what they're selling. So you want to have exposure there. I mean, that's what we're doing now with our investors. We've been positioning for years. In fact, I got positioned too early. I saw this train wreck coming from a mile away. Mm-hmm. So, I've been prepared for longer than necessary. But with the benefit of hindsight, it's easy to see, I buckled up too soon. But, the people that aren't buckled up at all, they're going right through the windshield, right? So, I mean, at least I'm protected. And, and you can start to see the relative performance of my portfolios. I mean, year to date, we're crushing it. I mean, a lot of my accounts are positive. A lot of my funds and while the markets are imploding. And even now, if you go back 2 or 3 years, we're outperforming even some funds now 5 years after, lagging. But I still have a lot of catching up to do over 10 years. Mm-hmm. But I think by the end of next year, I'll be caught up, and I think I'll even surpass everybody over the 10-year time horizon, because things are rapidly, rotating into my direction. Mm-hmm. But, the good news for people who haven't made that rotation yet is there's still plenty of time to do it. U.S. stocks are still very overpriced. The U.S. dollar is still very overpriced. So it's plenty of time. Even though the markets are down, they're still way up over a longer time horizon. You can still sell these overpriced U.S. stocks and U.S. dollars and get into much better valued foreign stocks, foreign currencies, commodities, so that you can actually have positive returns over the next decade. Because the people who are sitting in the U.S. stock market are going to lose money. And in terms of inflation, when they try to take those returns and make them real, the losses are going to be phenomenal.
So, Peter, do you think this is a new era for gold? And on that value side of the equation, does this make the gold mining business, as long as they have decent returns and pay a dividend, does that make it more attractive?
Yeah, well, I don't think, gold has ever gone away. It's just kind of been on the back burner for a while. And, mm-hmm. Maybe like Bitcoin or something stole the spotlight for a while, but that's done. I think gold's going to come back in a big way as people recognize the box that not only the Fed is in, but the Bank of Japan, the Bank of England, the ECB. So all of these major fiat currencies are going to be losing a lot of value. So you got to get rid of them. And then what do you buy? Well, gold is the obvious alternative if you want liquidity and you just want to store value and you don't want to hold these fiat currencies. If you want to invest, you have a lot of other options. You can buy stocks, you can buy real estate. But if you just want to keep some dry powder, gold is your best alternative. What I think is going to be interesting, though, about the next decade, and it's ironic from the perspective of the Bitcoin people, is they were certain that Bitcoin was the end of gold, and it's not. I mean, maybe gold is the end of Bitcoin, because the best use case for blockchain is gold, not Bitcoin. See, what the Bitcoin people liked about Bitcoin was that it was easier to use as a medium of exchange than gold, except nobody uses it as a medium of exchange because it's actually very inefficient. It's very volatile, it's very expensive, it's very slow. So people just use it as a gambling token. But I remember early days of Bitcoin that they would say, well, Peter, what good is your gold? You can't go into a Starbucks and buy some coffee with your bar of gold. What are you going to do? Shave off a little bit? And, no, but you can do it with Bitcoin. Well, you can't really buy coffee with Bitcoin